The rules just changed, not in a proposal being debated, not in a framework under consideration. The regulation has been passed. And starting Monday morning at 8:30 a.m., the silver market, as it has operated for the past 4 decades, undergoes a fundamental transformation. While charts were being watched, while silver pushed above $79, while headlines focused on Venezuela and Iran, the most significant regulatory shift in precious metals trading history quietly went into effect. And the mainstream financial media? They're silent. The same voices that have dismissed manipulation concerns for years, that insisted naked shorting was impossible, that claimed the paper market operated fairly and transparently, they're saying nothing. They're hoping this development goes unnoticed until it's too late. But we're paying attention, and what we're witnessing is nothing less than a fundamental restructuring of how banks can interact with the silver market. The paper trading mechanisms, the ability to sell unlimited quantities of silver that doesn't physically exist, the naked short positions that have capped rallies for decades. All of this is being addressed by regulation, by law, by the very authorities that previously turned a blind eye. Let me break down exactly what's happening, because even within the precious metals community, the full implications haven't been completely grasped yet. But before we dive deep, make sure to smash that like button for more precious metals market analysis. Drop your thoughts in the comments below and subscribe so you don't miss updates on this developing situation. For 40 years, certain market dynamics have operated in precious metals that would raise serious questions in other markets. Entities have sold silver they don't physically possess. Futures contracts have been created backed by promises to deliver metal that doesn't exist in accessible inventories. This infinite supply of paper silver has been used to absorb buying pressure, to suppress rallies, allowing accumulation of physical metal at lower prices. This isn't speculation or conspiracy theory. This is documented in market data. The ratio of paper claims to physical metal in the COMEX system has at times exceeded 100 to 1. 100 ounces of paper obligations for every ounce of deliverable metal. These were essentially phantom contracts. When futures were purchased under the belief they represented silver, they represented promises from entities with questionable ability or intention to actually deliver. Starting Monday, this changes. The new regulation requires banks to hold adequate capital reserves against their commodities positions. It requires them to demonstrate that short positions are backed by actual metal or legitimate hedging activity. It closes loopholes that allowed naked shorting to flourish. It forces banks to either cover their positions or face regulatory consequences. This is why social media chatter has exploded. This is why traders are discussing Monday morning like it's a major inflection point. This is why insiders who understand what's coming have been repositioning themselves before the opening bell. But there's something that makes this even more significant. According to reports circulating in trading communities, massive silver short positions have allegedly been transferred from American banks to Canadian banks over recent weeks. Billions of dollars worth of exposure reportedly shifted across the border. The question everyone's asking, why would this happen right before a major regulatory change? There are 2 possibilities being discussed, and neither suggest confidence in these positions. First possibility, Canadian banks may have believed they could operate under different jurisdictions and escape the new regulations. They may have thought US rules wouldn't apply to their operations. If this was the calculation, the regulations appear to be more coordinated than anticipated, and the loopholes appear to be closed. Now, these institutions are reportedly sitting on positions they cannot roll forward under the new framework and cannot afford to cover. Second possibility, this was a deliberate offloading. American banks may have recognized these positions were becoming untenable. They knew they couldn't hold them through the regulatory transition. So institutions were found, whether desperate enough or inadequately informed about timing, to accept these positions right before the music stopped. Perhaps incentives were offered, perhaps critical information about timing was withheld, but the result is the same. Either way, Canadian banks are reportedly holding billions of dollars in silver short positions that face new regulatory scrutiny Monday morning. And if they cannot cover, if the new regulations prevent them from simply rolling shorts forward, as has been standard practice, we could be looking at serious institutional stress. Posts circulating on social media are explicit. They're discussing potential bank bail-ins within hours. They're referencing Monday at 8:30 a.m. as a critical moment. They're talking about Canadian bank insolvency stemming from held silver shorts. Now, I need to be transparent here. I cannot independently verify every claim being made in these social media posts. I don't have access to internal position reports of Canadian banks, but what I can confirm is that the timing is notable. The regulatory change is documented and real, and the concern in certain circles is unmistakable. When multiple independent sources start discussing the same date, the same time, the same potential consequences, it warrants attention. When mainstream media goes silent on a major regulatory shift, while social media explodes with warnings, it raises questions about information flow. When insiders appear to be positioning for a Monday morning event, while the public remains largely unaware, it suggests preparation might be prudent. Here's what everyone needs to understand. Even if the bank insolvency scenario doesn't materialize exactly as some predict, even if bail-in fears prove overblown, the fundamental regulatory change is documented and real. Banks can no longer short silver with impunity. The paper suppression mechanisms are being dismantled by regulation. What happens to the price of any asset when entities that have been artificially suppressing it for 40 years are suddenly prohibited from continuing that practice? The price seeks its true level, and the true level for silver, based on supply deficits, industrial demand, monetary debasement, and decades of suppressed price discovery, appears to be substantially higher than current levels. This is why Motilal Oswal is predicting 27% upside from current levels. This is why analysts are calling for $82, $85, even $90 per ounce in the near term. This is why MCX silver targets are being raised to Rs. 256,000, Rs. 260,000, Rs. 270,000 per kilogram. Market analysts see what's developing. They see the suppression mechanisms ending, and they're positioning their analysis accordingly. But the regulatory shift isn't occurring in isolation. Multiple catalysts are converging simultaneously, creating what some describe as a perfect storm for precious metals. Look at Iran. Anti-government protests have erupted across the country. The regime is responding with crackdowns. Internet access has been restricted, and President Trump has made statements about potential intervention. The situation is volatile, unpredictable, and potentially explosive. What do investors do when geopolitical risk spikes? They seek safe haven assets, assets that cannot be bombed, cannot be sanctioned, cannot be frozen by foreign governments. They move toward gold and silver. They convert paper wealth into physical reality. Analysts are explicit about this connection. The latest spike in silver prices is being driven in part by Iran tensions and the threat of US involvement. MCX silver could open Monday at Rs. 256,000 per kilogram or higher. COMEX silver could gap toward $82. The geopolitical premium is being priced in, and the market hasn't even fully absorbed the regulatory news yet. Then there's Venezuela. Mainstream media wants the narrative to be that the silver rally is primarily about Venezuela. They emphasize US actions targeting Venezuela's oil network and broader fallout across energy and currency markets as the primary driver. This is misleading through omission. This is misdirection designed to make the rally appear temporary, suggesting that once Venezuela stabilizes, silver will retreat. The reality, the silver rally started long before Venezuela became this week's headline. The physical silver shortage has been developing for years. Industrial demand from solar, EVs, and AI has been growing exponentially while mining supply has remained flat. Vaults have been draining, deficits have been accumulating. The fundamentals have justified higher prices for an extended period. Venezuela is an accelerant, not a root cause. Iran is an accelerant, not a root cause. The cause is structural. The cause is permanent. The cause is the mathematical reality that the world needs more silver than it can produce, and price must rise to balance the equation. But mainstream media wants focus on temporary accelerants, so investors will sell when those headlines fade. They want the belief that when Venezuela calms down, when Iran stabilizes, the rally will end and profits should be taken. This misses the bigger picture. The regulatory change is permanent. The supply deficit is permanent. Industrial demand is permanent. Monetary debasement is permanent. Accelerants may come and go, but the underlying structural conditions are multi-year in nature. If you're finding this analysis valuable, go ahead and smash that like button, drop a comment with your perspective on these market developments, and subscribe for continued coverage as this situation evolves. Let me walk through what analysts are actually projecting, because the predictions emerging right now are remarkable. Anuj Gupta, an SEBI registered commodities specialist, is predicting silver may open with upside momentum on Monday and approach $82 to $85 per ounce. On MCX, he's targeting Rs 256,000 to Rs 260,000 per kilogram. These aren't speculative calls. These are considered predictions from registered analysts with professional reputations at stake. Pramod Amthy, CEO of Enrich Money and SEBI-registered wealth tech company, is predicting that if silver holds above Rs 253,000 per kilogram on MCX, it could rally to Rs 260,000 to Rs 270,000 per kilogram in coming weeks. He cites increased demand from solar, EV, and electronics industries amid aggressive accumulation on pullbacks. Let me translate those numbers for an international audience. Rs 270,000 per kilogram converts to approximately $100 per ounce. These are mainstream registered institutional analysts calling for silver to approach triple digits, not in a decade, not in 5 years, in the coming weeks. The technical analysis supports these targets. MCX silver shot up to Rs 252,725 per kilogram last week. The precious metal broke out from its consolidation range, confirming a strong bullish channel. On COMEX, silver surged to $79 per ounce. The immediate support level is $75 to $78, which coincides with previous swing lows and channel support. The key breakout level is $82 per ounce. If silver sustains above $80, the path to $85 to $90 opens up with minimal resistance. The technical picture indicates continuation. The fundamentals indicate shortage. The geopolitical picture indicates safe haven demand. And starting Monday, the regulatory picture indicates the end of unlimited paper suppression. Every input from every angle points in the same direction, higher. Now, let me address something mainstream media consistently does. They select one narrative and use it to dismiss the entire rally. They say it's all about Venezuela. They say it's all about Iran. They say it's all about speculation. They ignore the multi-layered fundamental case because acknowledging it would force admission that silver isn't a trade, but a generational repricing. The physical silver shortage is real. It didn't start this week. It didn't start with Venezuela. It has been building for years. The Silver Institute has documented consecutive years of supply deficits. Metals Focus has projected deficits extending into 2026 and beyond. The drawdown in Western vault inventories has exceeded 70% since 2020. China has implemented export restrictions that effectively remove 65% of globally available refined silver from open markets. This isn't speculation. This is documented data. This is the reality of a market where demand exceeds supply and has exceeded supply for years. Every ounce that exits vaults, every deficit that accumulates, tightens constraints on the paper market. The industrial demand is real. It didn't start this week. Silver is the best electrical conductor among all metals. It's irreplaceable in solar panels. It's essential in electric vehicle contacts and batteries. It's critical for 5G infrastructure and AI data centers. The green energy transition that governments worldwide have mandated is silver intensive. The AI revolution reshaping the global economy is silver intensive. This isn't speculation. This is physics. Silver conducts electricity better than any alternative. The industries of the future run on electricity. You cannot substitute away from silver demand without accepting significant performance degradation. In competitive markets, performance matters. The monetary debasement is real. It didn't start this week. US national debt has exceeded $38 trillion. Interest payments alone now exceed $2 trillion per year. The only viable path out of this debt trap involves inflating it away, printing money until real debt value shrinks to manageable levels. But printing money debases currency. It destroys purchasing power. It drives capital into hard assets that cannot be diluted. This isn't speculation. This is mathematics. When you divide a growing money supply by a fixed quantity of physical metal, the price of metal must rise. Silver cannot be printed. Silver cannot be created by central bank keystroke. Silver is finite and real. These three pillars, the shortage, the industrial demand, and the monetary debasement, have been in place for years. They are the foundation of the silver structural story. Venezuela is not the foundation. Iran is not the foundation. They are events that accelerate movement along a trajectory that was already established. And now, on top of these three pillars, we're adding a fourth: the end of unlimited paper manipulation. When new banking regulations take effect Monday, entities that have been fighting this structural trend with paper mechanisms will be constrained. They will not be able to sell unlimited amounts of silver they don't physically possess. They will not be able to create phantom supply to suppress rallies. They will not be able to manipulate price with impunity. For the first time in 40 years, the silver market will have to function based on actual supply meeting actual demand. And actual supply is substantially less than actual demand, which means price must rise to create equilibrium. This is why Monday matters. This is why 8:30 a.m. is circled on informed traders' calendars. This is why social media chatter has reached fever pitch. We're not just watching a rally. We're watching a regime change. We're watching transition from a manipulated market structure to market-based price discovery. We're watching silver price begin to reflect reality after 4 decades of suppression. The banks understand this. That's why there's apparent panic. That's why positions are reportedly being shuffled across borders. That's why mainstream media is attempting to redirect attention toward Venezuela and Iran instead of focusing on the regulatory shift about to occur. They don't want widespread understanding of what's happening. They don't want the public positioned. They want confusion, distraction, and selling into their bids so accumulation can occur before repricing. Let me discuss what could happen Monday morning, because the range of potential outcomes is extraordinary. If the Canadian bank insolvency scenario materializes, if billions in silver shorts cannot be covered and institutions face collapse, we could witness gap-ups in silver prices unlike anything seen in our lifetimes. We're potentially talking about $10, $20, maybe larger moves in a single session as shorts are forced to cover at any available price. But even if the bank scenario proves less dramatic than most extreme predictions, the regulatory impact alone should drive significant price appreciation. When entities that have been selling unlimited paper are suddenly prohibited from doing so, selling pressure disappears. In a market where buyers are industrial users who need the metal, where buyers are central banks diversifying away from dollars, where buyers are retail accumulators who understand fundamentals, removing sellers doesn't create equilibrium. It creates a vacuum. And in that vacuum, price will rise to wherever necessary to attract new sellers. But who will sell silver right now? Who will part with physical metal when fundamentals are this constructive, when manipulation is ending, when geopolitical chaos is intensifying? Very few participants, which means price may need to rise dramatically to incentivize any meaningful selling, which means the gap up on Monday could be just the beginning of a move toward triple digits. Make sure you're hitting that like button if this analysis is helping you understand these market dynamics. Comment your perspective below and subscribe to stay informed as this situation develops through the week. Motilal Oswal's 27% upside prediction would take silver from current levels near $80 to approximately $100. And that prediction was made before full implications of Monday's regulatory change were understood by the broader market. As awareness spreads, as implications sink in, price targets will likely be revised higher. UBS has already predicted silver could reach triple digits in 2026. Jim Rickards has called for $200. The gold to silver ratio, which historically trades between 30 and 50, remains elevated, providing mathematical support for continued silver outperformance relative to gold. We're not discussing a trade here. We're not discussing a quick position for 10% profit. We're discussing a structural repricing that could see silver multiple from current levels over coming months and years. And it begins Monday. Let me address the psychology of what's about to occur, because understanding psychology is as important as understanding fundamentals. For 40 years, silver investors have been conditioned to expect disappointment. Every rally has been capped. Every breakout has failed. Every hopeful moment has been followed by brutal reversals that shook out participants and transferred metal from retail to institutional holders. This conditioning runs deep. Even now, with price at multi-year highs, with fundamentals indicating higher prices, many silver investors are psychologically prepared for disappointment. They're waiting for the reversal. They're expecting the rug pull. They cannot fully embrace the structural trend because they've been hurt too many times before. But the rules have changed. The mechanism that used to create those reversals, the infinite paper selling that crushed rallies, is being removed. The weapon is being taken from those who wielded it. Without that weapon, they cannot do what they've always done. This is the hardest thing for long-suffering silver investors to internalize. The game has changed. The tactics that worked for 40 years won't work under the new regulatory framework. The disappointment they're conditioned to expect may not materialize in the same way. I'm not saying there will be no volatility. I'm not saying price will move straight up without corrections. Markets don't work that way. There will be pullbacks. There will be shakeouts. There will be days when it feels like old patterns are returning. But the structural ability to suppress silver with unlimited paper is ending. Corrections will be different in character than multi-year bear markets. Shakeouts will transfer metal from weak hands to strong hands, concentrating ownership among those who understand the thesis. The multi-year trajectory is structurally higher. Now let me discuss preparation, because understanding what's happening is meaningless without proper positioning to navigate it. I'm not providing financial advice. I'm discussing how different market participants are viewing this situation. Those holding physical silver are largely viewing Monday's potential volatility, whether up or down, as noise against a longer-term structural trend. The opening hours of trading under new regulatory framework will likely be chaotic. There may be gaps, whipsaws, and confusion as the market adjusts. Those holding mining stocks are preparing for volatility while staying focused on the trend. Miners provide leverage to moves in the underlying metal. If silver reaches $100, quality miners could appreciate substantially, but they're also more volatile on a daily basis. Those sitting on cash and considering entry are recognizing that time is limited. The regulatory change happens Monday. The positioning ideally occurs before Monday. Waiting to see what happens may mean entering at significantly higher prices. Those holding paper instruments, whether futures or ETFs, are evaluating counterparty risk exposure. In a delivery crisis, in a bank insolvency scenario, paper claims may not be honored at stated value. Physical metal in possession carries no counterparty risk. Most importantly, don't let mainstream media narratives create confusion. They will attempt to explain Monday's move as purely a reaction to Venezuela or Iran. They will frame it as temporary. They will suggest selling into strength because geopolitical premiums will fade. The geopolitical premium is real, but it's not the primary driver. The regulatory change is the primary driver. The supply deficit is the primary driver. Industrial demand is the primary driver. Monetary debasement is the primary driver. None of these factors are fading. They're intensifying. This is the moment that separates the old suppressed market structure from new market-based price discovery. This is the Monday that could change everything. Banks are exiting the unlimited paper trading game. New regulation takes effect at 8:30 a.m. Shorts are coming due. Vaults are depleted. Industrial users are securing supply. Central banks are accumulating. Every analyst covering this market is constructive. Motilal Oswal, 27% upside. SEBI-registered specialists, $82 to $85 near term. Technical analysts, breakout above $82 opens path to $90. The consensus is remarkably aligned, though the consensus doesn't yet fully appreciate the regulatory dimension. When the market comprehends that Monday marks the end of unlimited paper manipulation, price targets will be revised upward again. We're in the final hours before potentially the most significant event in silver market history since the Hunt brothers situation of 1980. And unlike 1980, when the establishment changed rules to save themselves, this time the rule change is constraining their actions. This time regulation is forcing them out of the manipulation mechanisms. This time assistance isn't coming to their rescue. $82 is the near-term target. $85 is the breakout level. $90 is possible in coming weeks. $100 is on the table for 2026. Beyond that, if ratio compression plays out, if de-dollarization accelerates, if industrial demand continues growing, $150 to $200, even higher targets become plausible under certain scenarios. This isn't a trade. This is a repricing. This is the market finally reflecting reality that's been documented for years. This is the end of suppression and the beginning of true price discovery. Monday at 8:30 a.m., banks are constrained by new rules. Shorts are due. The regulatory framework has changed fundamentally. The volatility ahead is the price of admission for whatever gains may materialize. The 40-year wait could be ending. The new era potentially begins Monday. Thanks for watching. Smash that like button one final time, comment your thoughts on Monday's potential developments, and subscribe for continued coverage. See you on the other side.